Introduction to Managerial Accounting. We'll go through what the differences of managerial accounting and financial accounting are, and look at some of the costs associated with managerial accounting. First, let's take a look at the differences between financial accounting and managerial accounting. If you recall, in financial accounting, our focus was on the external users. Therefore, we were required to follow rules such as GAAP, or Generally Accepted Accounting Principles. Also, all the data that we worked with was from the past, and therefore we were looking to make sure our information was accurate and reliable. In managerial accounting, our objective is to give management tools to make decisions. Therefore, there are no rules to follow. And typically, what we're trying to do is make the best information available at the time. So therefore, our information might not be as accurate as long as it's helpful in making that decision. In management, we are required to do various tasks. Some of these tasks include planning, directing, controlling, improving, and decision making. And we'll take a look at some of these aspects throughout this course. In managerial accounting, we're going to talk about a lot of different costs. First, let's talk about direct costs versus indirect costs. Costs are anything that goes into making a product or anything that goes into generating revenue for a business. When we talk about direct costs, we're looking at costs that can be traced directly to a product. Indirect costs are used to make a product, but they cannot be traced directly to a product. An example of this would be if we were building a car, a direct cost might be the wheel because we can trace directly which wheel went to which car by those serial numbers. An indirect cost would be the oil or the grease that went into making this car, putting those wheels on. We're not going to take the time to actually identify which or how much grease went into putting that tire on. We just call that an indirect cost. When we talk about manufacturing costs, we're talking about what costs go into making a product. And there are three costs that go into making a product. These are the direct material cost, the direct labor cost, and factory overhead. We'll take a look at each of these individually to give you more examples of what would go into each of those individual costs. For direct material costs, these are costs that are an integral part of the finished product and can be a significant portion of the total cost of a product. Again, a direct cost can be traced directly to the product. For example, if we're talking about making a kitchen table, a direct material cost would be the lumber that went into making that table. The second cost of our manufacturing costs are the direct labor costs. Again, these are an integral part of the finished product and a significant portion of the total cost. These again are traced directly to the product. An example of a direct labor cost when making these kitchen tables would be the person who's actually putting the table together or sanding down the table. We can see that their work is directly related to that finished product. And finally, our factory overhead costs. Factory overhead is any of these indirect costs that go into making the product but can't be traced directly to the product. An example of this, if we're talking about our kitchen tables, would be maybe the screws or the nails that go into putting that lumber together. Or maybe the lights of the factory. The lights have to be on in order to make these products, but we're not going to be able to trace those costs directly to which table was made, and therefore they would go into our factory overhead. Another way to classify costs is to separate them between product cost and period cost. Product costs are those three manufacturing costs: direct materials, direct labor, and factory overhead. Period costs are your selling and administrative costs. These costs are expensed immediately and therefore will show up on your income statement. Your product costs, your direct materials, your direct labor, and your factory overhead will be put into your work in process account and attach itself to your inventory. And because inventory is an asset, it will show up on the balance sheet. Let's take a look at how these costs relate to our manufacturing cycle. Again, we have our manufacturing costs, which are our three product costs: direct materials, direct labor, and factory overhead. Once these three costs are assigned to a job, they get moved to the manufacturing process and put into our work in process inventory. Once the work in process inventory is complete, they're moved to finished goods. While all of these products are either in unused materials, work in process, or finished goods, they are part of our inventory and therefore are on our balance sheet as an asset. Once they are sold, these product costs get moved to our cost of goods sold and show up on our income statement. Therefore, all of those product costs are going to be an asset on our balance sheet until they're sold, and at that point they will become an expense, and that expense is recorded in our cost of goods sold.